Alright guys, welcome. In this video we're going to talk about the 8 trading mistakes that drain accounts, and more importantly, how you stop them. Now, before we get into this list, it's important to understand something. What happens above the surface in your trading is usually a result of what happens below the surface. Your thoughts create emotions, your emotions influence your decisions, and those decisions create your results. That cycle is what destroys most traders. So if you want different results, you can't just focus on strategy. You have to look at your behavior, your habits, and your emotional responses. That's the real work. So let's get into it. Number 1, emotional triggers. Fear, greed, impulsiveness, FOMO. This is one of the biggest account killers in trading. Every trader experienced it. Holding trades for too long because of greed, cutting winners short because of fear, chasing trades because they don't want to miss out, or over leveraging because they feel certain. The market's designed to exploit your emotions. And if you don't control those emotions, they'll destroy your account. I used to run a Forex desk in the city, and I saw this happen constantly. Most traders weren't losing because they lacked information, they were losing because of behavior. So how do you fix it? Well, first, have predefined entry and exit rules before you enter. Know why you're entering, where your stop is, where your target is, and what invalidates your trade. Second, create a call-off rule. If you feel emotional, frustrated, impulsive, or desperate to make money back, step away from the screen. Go for a walk, grab a coffee, clear your head. And third, reduce your position size. If your trade size is creating emotional stress, it's too big for where you are psychologically right now. Trading larger sizes is like lifting heavier weights in the gym. You build up to it gradually. Number 2, lack of patience. This is one of the most common mistakes traders make. People get bored. They feel like they need to be doing something, so they force trades that aren't really there. The market doesn't reward activity, it rewards discipline. So instead of looking for trades constantly, wait for your best setups only. Create a checklist or keep a scorecard for your setup. For example, if your trade needs 5 conditions to be met, then all 5 must be present before you enter. Not 3, not almost, but all 5. That stops you from forcing trades early. And also remember, cash is also a position. Sometimes the best trade is no trade. A tiger doesn't rush, it waits, it watches, and then when the moment is right, it attacks. That's how traders need to think. Moving on, number 3, overtrading. This is the compulsion to always be in the market. Some traders feel uncomfortable doing nothing, so they keep pressing buttons. But more trades does not mean more profit. Usually it means more emotional mistakes. So set a maximum number of trades per day or per week. For example, maybe your rule is a maximum of 3 trades per day. That forces you to become selective. And also create a daily loss limit. If you hit your limit, stop trading. No revenge trading, no trying to win it back, because once emotions take over, decision making collapses. One great trade is worth more than 10 mediocre trades. Think quality over quantity, always. Number 4, lack of a trading plan. Trading without a plan is like trying to travel somewhere without a map. Your trading plan defines your edge. It tells you when to enter, when to stay out, how much to risk, how to manage trades, and what conditions must be present. The purpose of a plan is to remove all emotional decision making, because the market does not care what you think. It rewards disciplined execution, not opinions. A lot of traders say things like, I think the price is going higher. But what matters is, what does your system say? If your plan says no trade, then it's no trade. Simple. Number 5, ignoring risk management. This is one of the biggest sins in trading. Oversized positions, moving stop losses, risking too much on one idea. This destroys accounts. One emotional trade can wipe out weeks or months of progress. And one dangerous thing traders do is move their stop losses. Now, sometimes they get rewarded for it. Price turns around, trade wins, and that's dangerous, because now the brain starts believing moving stops works. But over time, that behavior destroys consistency. So risk small, keep losses controlled, and protect your capital. For most traders, 0.5 to 1% risk per trade is enough. Use hard stop losses. Do not widen them emotionally. And always calculate your position size before entering. Risk management keeps you in the game long enough to improve. Number 6, chasing the market. This is pure FOMO. The market starts moving and traders panic. I'm going to miss the move, they think. So they jump in emotionally at terrible prices. Professional traders don't chase, they wait. You need clear no chase rules. For example, only enter on pullbacks, retests, structure confirmations, moving averages, supply and demand zones, etc. Whatever your system is, follow it and accept this. Accept this fact: you will miss trades. This is normal. Missing trades is far better than buying tops and selling bottoms. There will always be another setup. Number 7, inconsistent execution. This is when traders have rules but don't follow them. I did this myself for years, so I understand. I have rules written down. I had them written down, but I wasn't actually following them consistently. Knowing the rules and executing the rules are two completely different things. So create a process. Before trading, read your rules. Use a checklist before every trade. Now, treat trading like a professional performance activity, because nobody's going to police your behaviour except you. And if you constantly break your own rules, eventually your account balance will expose it. The market always finds out. Right, number 8, last but not least, lack of self-reflection. If you don't review your behaviour, you'll keep repeating the same mistakes. A lot of traders journal incorrectly. You don't need to write down meaningless details. What matters is screenshots, why you entered, what you were thinking, what emotions were present, and whether you followed your rules. That's the important part. Your journal should help you identify patterns in your behavior. At the end of every trade, review your trades. Look for those emotional mistakes, repeated errors, strengths, weaknesses, and psychological leaks. That reflection process is where improvement happens. So start working on this now. Pick 2 mistakes you struggle with most. Create one specific rule to address each one, and then track your behavior for the next 30 days. Because this is the work. This is non-negotiable. Nobody can do it for you. And if you're not seeing the success you should be seeing, then something needs to change. Thanks for watching. If you found value in this video, subscribe, like, comment, share, and hit the bell so you don't miss future videos. And remember, do the work.